Interest rates. You've probably heard the term thrown around a lot on the news and conversations, but what do they actually mean? And more importantly, how do they affect you? Let's break it down. First off, interest rates are basically the cost of borrowing money. Say you take out a loan for a house or a car. The interest is what the bank charges on top of the money you're borrowing. Think of it like renting money, except instead of paying rent to a landlord, you're paying it to your lender. The higher the interest rate, the more rent you pay. Now here's where things get interesting. Interest rates don't just stay the same. They go up and down depending on the economy. When prices for things like groceries, gas, and rent are rising too fast, the Federal Reserve, or the Fed, steps in and raises rates to slow things down. It's kind of like turning down the heat on a boiling pot. When interest rates are higher, it costs more to borrow, so people and businesses tend to spend less. That's one way to keep inflation, when prices rise too quickly, from getting out of hand. But when the economy starts slowing down, like during a recession, the Fed does the opposite. They lower interest rates to make borrowing cheaper. The idea here is to encourage people to take out loans for homes or cars, and for businesses to invest. All that extra spending helps boost the economy. So, when you hear about the Fed cutting rates, it means they're trying to get the economy moving by making it easier for everyone to borrow and spend. Okay, now let's talk about how this affects you. Interest rates impact your everyday life in ways you might not even notice. When rates go up, borrowing money gets more expensive. So, if you have a mortgage or a car loan, your monthly payments can increase. When interest rates rise, buying a house gets pricier because your loan payments increase. And it's not just mortgages. Credit cards are affected too. If you don't pay off your balance, a higher rate means you're paying even more interest. But it's not all bad news. Higher interest rates can actually help you if you're saving money. You'll earn more interest on your savings, which is great for savers. You've probably heard about the Fed making a quarter point or half point cut to interest rates. So, what does that mean? A quarter point cut is a small reduction, like a gentle nudge. A half point cut? That's a bigger move, like jumping in with both feet. The Fed looks at things like jobs reports and inflation to decide how big a rate cut should be. If the economy is really slowing down, they might go for a bigger cut to stop things from getting worse. But if it's just a slight slowdown, they'll start with something smaller. Jobs reports are kind of like a health check for the economy. If people are losing jobs, it's a warning sign for the Fed. They might cut rates to help, but if jobs are growing steadily, they'll probably hold off or make a smaller cut, just to keep things balanced. The Fed has to weigh all this data carefully, because if they don't make a big enough cut when needed, the economy could stall. So, what should you do when rates change? If you've got debt, like a mortgage or credit card, keep an eye on those interest rates. If they're going up, it might be smart to lock in a fixed rate or pay off any high-interest debt as soon as you can. And if you're saving, higher rates can actually work in your favor. Look around for higher interest savings accounts and make sure your money's working as hard as possible. Want to dive deeper into how the Fed's decisions impact your finances? Watch our next video where we'll give you all the tips you need.